The key is the broader indices are at essentially knocking on historic highs. Let's just take a look at the big indices right now. Remember the key point, S&P small cap, essentially historic high right now. S&P mid cap, essentially historic high. So mid caps, guys like, what would you call mid cap? Five below maybe? I'm trying to think, I don't have a list. Dunkin' Brands, Murphy Oil. Those kinds of stocks, small caps, Worldwide Wrestling, a lot of the retailers like Guess, Fossil, Abercrombie, those are small cap stocks. That's essentially an historic high. S&P 500, the closing high, 28.72. Right now we're 28.59, so 12 points away from that. NASDAQ 100, we're close 750. We're maybe 1% away from that. That's the key right now. Global markets, just take a look. This is what I keep talking about. The U.S. is the place to invest. We're only 0.5% from a historic high in the S&P. Germany 7% away. India has had a great year. They are also knocking on the door of historic highs right now. And look at that difference between India and Shanghai. You are not going to see that very often. Two developing countries. That's about as far apart as they have ever been in terms of distance from their new highs. Of course, we've got a slowing growth in India, weaker yuan, tariff concerns. That's really knocking the wind out of them here. Here in the U.S., you got energy, tech, materials doing well, consumer staples finally taking a break. Pepsi, Coke down, Clorox, Kraft finally taking a break. They have had a tremendous run. Not surprising they're slowing down. So why are we doing so well? I keep saying it's simple. The U.S. is the place to be right now. Strong earnings story. We've got GDP growth. That's a good story. We have a tidal wave of buybacks that often, but not always, actually results in share count reductions, which is what we want. We have dividends growing, limited tariff impact, and we have sector rotation. When tech lags, they go into value. They buy consumer staples. That's what's keeping the market up. Yes, there are reasons to worry. You want a short list? Okay, here's a short list. We could be worried about rate hikes. We could be worried that tech will be vulnerable. We could be worried about trade wars. We could be worried about margin pressure. I do worry a little bit about margin pressure, particularly on the cost side. Decelerating earnings growth, I'm sorry, we are getting earnings growth all the way into 2019. You can have the market go up on somewhat decelerating earnings growth. It's happened many, many times in the past. Peak earnings is not a real story to talk about. What we're missing, you know what I'm missing? Where's all the new highs? We have a small number of new highs out there, and that tells you a small group of stocks are really moving. And of course, Apple's at a new high. Disney is. We'll get the earnings from them. The railroads are doing well. Target is, but it's small. 50 stocks on the NYSE today out of 2,500. That's a pretty small breakout group. What about? Reminder here, laggards. There are plenty of companies that are a long, long way from 52-week highs. General Electric is 50% off its highs. Whirlpool, Cummins, a lot of industrials that had problems with tariffs, they're getting hit and having problems. There's still a whole bunch of retailers that haven't gone anywhere. L Brands is one. And of course, a lot of those famous investing companies have been down because of the price wars that we're seeing for competition for everybody's investing dollar. Invesco is a good example. So right now, 28.58 on the S&P, 28.72 is the old historic high. Carl, back to you.